Dear students, today we were going to look at how to prepare the statement of financial position using a list of balances that are provided for us. Helping us today will be the question on workbook, page 51, question 6. So let's begin. Now on your left is a list of balances that were provided to us in that question. We're asked to prepare this statement of financial position as at the 31st December 2006. Now it's always a good idea to have an idea of how your final answer will look like. So if you look at your right now on the screen, you will notice that the very top of the statement will list out the name of the business. Second line will tell us the title of this statement, as at, in this case, the last day of the year, 31st December 2006. Now, as you have read your textbook, in the statement of financial position, there are 5 categories of items. 2 belongs to assets, which you will need to highlight as a title, assets. The first category is the non-current assets. Now these are resources owned by the business that will bring benefits beyond 1 year. Now the second category is current assets. Now these are assets, resources that are owned by the business that has benefit for 1 year, or it is easily convertible to cash. Now the combined value of non-current assets and current assets will give you total assets. Now we put this as a green section. The second section is the equity and liabilities section. There are 3 more categories. Okay, one is the owner's equity, which is actually the calculated figure of the beginning capital, add to the profit that you earn for the year, subtract the drawings that the owner took out for personal use. Fourth category is known as the non-current liabilities. Now these are obligations that the business is expected to repay, but in this case beyond 1 year. So they have more than a year to repay this debt. The last category is known as the current liabilities. Now these are obligations of the business that are due within 1 year. That means the business are expected to pay these liabilities within 1 year. Now, so there are these 5 categories of items found in the statement of financial position. Now, what we need to do now, as we look at the question, is for each item, we are to identify whether the item belongs to which of the 5 categories. Alright, so let's begin. Now, on the question paper, we will list out with each item, what they belong to. Now, we'll use some simple notation to help us record that. Now, for example, the profit for the year. Now it's known as equity, so we'll put an E to represent that. Capital at the beginning of the year, 1st January 2006, is also under category E. Fixtures and fittings are resources that are owned by the business that has benefit that lasts for more than 1 year. So these are known as non-current assets. We will use NCA to represent that. Trade payables are debts that need to be repaid within 1 year. So they are known as current liabilities. Trade receivables are assets that are easily convertible to cash. Okay, so it is known as current assets. Long-term loan is obligations of the business that are expected to be repaid beyond 1 year. So it is known as non-current liabilities. Inventory is an asset that is easily convertible to cash, or it can be used up within a year. So it's known as current asset. Motor van brings benefit that lasts for more than 1 year. So it's known as a non-current asset. Cash in hand is cash. Okay, so it is a current asset. Drawings is a withdrawal by the owner for personal use. It's part of equity. Cash at bank is cash, just like cash in hand. They are classified as current assets. So there we have all the items identified by their categories. Now what you need to do next is very simply to put each of these items in the right category on the statement of financial position. So we look at the statement, the first thing we list is always the assets. So we have the title of the asset, then 2 categories. The first category we must name non-current assets. Now in this question, there are 2 non-current assets. So we're going to put these 2 figures in there. First one, fixtures and fittings. second is your motor van. Now the combined value we will put in column M. So we have $94,230 worth of non-current assets. Now is the time to list out the current assets. Now for current assets, if we look at the categorization, we have 4 items. So each of these items need to be placed in there. Okay, so let's begin. Current assets, inventory, cash in hand, cash at bank. And the subtotal give us and therefore the total assets is total non-current assets add total current assets. Now we come to the equity and liability section. Under owner's equity, there's only one category, one term that we use, capital, that each consists of the beginning capital of 58,995, add to the profit that you earn for the entire year, 12,549. Now if it is a loss for the year, then it will be a reduction of your capital, so it will be minus. But in this case, because it's a profit, we add. And then we take away 2,645 for the drawings, because the owner took out equity from the business. Okay, the figure therefore we can put in column M because there's only a single figure, there's no subtotal to talk about. So 58,995 add 12,549, subtract away the drawings of 2,645, and we have 68,899. Now non-current liabilities, there's only one item called long-term loan as an account. But when we classify in the statement of financial position, we rename it as long-term borrowings. Alright, there's only a single figure, so we put the 40,000 in the column M. Finally, the last category is current liabilities. Now there are two items, there's a single item only for current liabilities called trade payables. So we just need to show this in the statement of financial position and put the amount 9548, the trade payables, in the column M because there's only a single figure. Now the last thing to do is the total equity and liabilities amount is a sum of all these three numbers. So we add 68,899, the capital, add to the long-term borrowings, add to the current liabilities. And we have our final answer, total equity and liabilities of 118,447. And it must agree with the total assets of 118,447 because the accounting equation works. Total assets must always be equal to equity plus total liabilities. That's end for today's lesson.